Do you want to hear something that's going to shock you? While inflation has been out of control the last 2 or 3 years, and the IRS has made some adjustments for inflation, there's a ton of deductions that would reduce our taxes that they're not touching. There's been no adjustment on these, and some of them are quite substantial. And in today's video, I'm going to share with you what they are and how they may impact you. And one of these goes all the way back to 1976. So let's start with the most current ones that have not been adjusted for inflation. And then we'll go all the way back to 1976, which actually it's the 1984 one. That's the biggest one. And hopefully you'll see why. Hopefully it impacts all of us at some point, because if it doesn't impact us, unfortunately, it means we died. So let's go for a walk and I'll share with you what these deductions are that could reduce your taxes, but they're not being adjusted for inflation, so they're not keeping up. And can you imagine what a deduction in 1976 that was set, what that would be worth today if it had been adjusted for inflation? So let's talk about it. You know, the most recent one are the deductions that are in the Tax Cuts and Jobs Act of 2018. And those include some really big ones. The first one's a $10,000 deduction. Think about how inflation has really taken off since 2018. So the first one is what's called the SALT deduction, S-A-L-T, which stands for state and local taxes. And it also includes your property tax. And a lot of us have seen our property tax bill really shoot out of control in the last couple years. So the fact that this is limited to $10,000 a year and hasn't been adjusted, that impacts a lot of us, because if your property taxes, your state and your local tax collectively is over $10,000, you can only deduct the first $10,000. So that's the first one. That's from that 2018 Act. Another one from the 2018 Act is we can no longer deduct all of the interest on our mortgages. It used to be, it was kind of an unlimited deduction. Now I should say, I'm not an accountant. I'm sharing this with you so it's on your radar screen. It's something that you think about, but I do want you to talk to your accountant so you know. So that deduction now is only for the first $750,000 of your mortgage. And I know that sounds like a big mortgage, but think about how many more Americans today have a mortgage of that size, and interest rates are quite a bit higher now. So that's a big one. It doesn't impact as many of us, but it does impact people, and much more people today than before. Okay, now we're going down to 1997, and this impacts a lot more of us. That is the capital gains exemption on your home. Again, I'm not an accountant. You should talk to your own accountant or a fee-only financial advisor. But this was set up in 1997, that the first $500,000 for a married couple, the first $500,000 of gain was exempt from capital gains tax, as long as there's some requirements. And again, talk to your accountant. Essentially, as long as you lived in your house, it was your primary residence for 2 out of the last 5 years. That's not been adjusted since 1997, so that's over a quarter of a century, right? And before that, when you sold your house, the only way to avoid paying capital gains was if you rolled it into a new house. So I like that, you know, you didn't have to buy another house if that's not what you wanted to do. And it had to be a more expensive house as well. So downsizing would trigger capital gains before 1997. Okay, the next one is the capital loss deduction. So if you lose money on stocks, let's say you've held it over a year, so it's a long-term capital gain. It used to be, well, it still is, $3,000 of that loss you can actually deduct from your ordinary income taxes, which tend to be at a much higher rate than the capital gains, right? So it's $3,000 today. That was the one that was said in 1976, but the 1984 one, which is much bigger, is coming up, so stay tuned. It was $3,000, and the last time that had been adjusted was in 1951 when it was created. It was $1,000 capital loss deduction. And in 1976, they increased that to $3,000. Not coincidentally, you know, when the country was starting to experience higher rates of inflation. Okay, another thing to note, and this is going to surprise a lot of you, maybe not if you live in these states, a lot of states do not adjust their earned income tax brackets for inflation. Turns out there's over 10 states, including a very high cost of living state, and a place that a lot of people make really nice salaries, which is New York. Obviously, New York City is where those high salaries are paid, but there are, is it exactly, no, it's over 10 that do not adjust the income bracket. So if somebody was making $75,000 and because of inflation, they got, let's say, a $10,000 raise, and that bumps those incremental dollars in the higher tax bracket, those states do not automatically adjust those brackets based on inflation. So that's painful. Okay, so what is this big one? What is the one that has not been adjusted since 1984? And I'm fibbing a little bit. There was an adjustment in 1997, but it made it much, much worse for all of us. So we wish that adjustment had not taken place. And that is the taxation of Social Security. You know, the first Social Security checks, along with the first FICA taxes, and FICA, the Federal Insurance Contribution Account, FICA, those taxes that we pay on our income, and for most of us, our employer matches. That started in 1937. First Social Security checks went out then. And until 1984, Social Security was 100% not subject to income taxes. And in 1984, they started doing the math, right? We all know something has to be done about Social Security. They started doing the math and said, we have to do something. So actually under Ronald Reagan, Congress passed and President Reagan signed that for married couples filing jointly, anything that they made above $32,000 was going to be taxed, any income total, including part of their Social Security benefits, if they made more than $32,000, then half of their Social Security was going to be taxed. It's called the provisional or combined income. So you look at your adjusted gross income, you toss in non-taxed interest, like maybe tax-free municipal bonds, and then half of the Social Security. And so if that provisional or combined income is greater than $32,000, it's going to be taxed at 50%. And then in 1997, Bill Clinton signed into law that said something, you know, between $32,000 and $44,000, it's going to be taxed at 50%. But above that $44,000, it's going to be taxed at 85%. So again, that's something that we all wish didn't, it probably had to happen, but some we all wish didn't have to happen. So those are the things that the IRS does not adjust for. And I should say Congress, it's really not the IRS. Congress has not put in an index inflation, and those things hurt us. But if you want to see what the IRS income tax brackets are for 2024, which is kind of part 2 of this video, I didn't want to make it too long, but look at that video over there, the 2024 tax brackets and what we're going to have to pay for tax on money that we make in 2024. I'll see you in there. Bye-bye.